Welcome to TalkTickers. You're joining us for a deep dive into the Bank of California's recent earnings call.
That's right. We've dug through it.
And our goal, as always, is simple. Cut through the noise, give you the key insights, basically a shortcut to understanding what really matters.
Exactly. Let's get into the numbers first.
Yeah, let's start with this snapshot. What did Q1 look like for them?
Okay, so for Q1 2025, Bank of California reported net income of $43.6 million, which works out to about $0.26 per share.
Got it. And loan growth, always a key metric.
Yeah, pretty solid, actually. Annualized loan growth hit 6% in the quarter. They generated about, $2.6 billion in new loans.
$2.6 billion. And what about the yield on those new loans?
That was quite strong, 7.2%, which, is significantly higher than their overall portfolio yield.
Much what?
5.9% on average for the portfolio. So that new production is definitely helping.
Okay, makes sense. Anything else jump out from the headline numbers?
Well, the net interest margin, it ticked up slightly, just 4 basis points, but still up to 3.08%.
Positive movement there.
And a pretty big share buyback was completed, $150 million.
Wow, okay. What percentage of shares is that?
That represented about 6.8% of their outstanding shares, so quite significant.
Definitely. Any flags? I saw something about classified loans.
Yeah, they did see an increase in classified loans, but, and this is important, they stressed it was mainly because they adopted a more conservative approach to risk rating.
So a policy change driving that.
Seems like it. And they pointed out that 84% of those newly classified loans are actually still performing, still current on payments.
Okay, that's crucial context. So not necessarily bad loans, just rated more cautiously now.
Precisely. And on the deposit side, non-interest-bearing deposits included about $1.2 billion in HOA deposits at the end of March.
All right, interesting mix. Let's dig a bit deeper then. That conservative risk rating. Tell me more about that.
So management was quite clear they implemented this stricter stance in Q1. It primarily impacted some rate-sensitive multifamily loans.
Multifamily, okay.
Yeah, these loans are generally still current. They have strong collateral, low loan-to-values. But because of, the interest rate environment and potential repricing risk down the line,
their performance metrics might have weakened slightly, even if they're paying.
Exactly. The bank saw potential deterioration and proactively downgraded them based on those metrics, not based on actual missed payments.
So it's anticipating trouble, not reacting to it.
Right. And overall, even with this increase, 81% of all their classified assets are still current.
Okay. That paints a different picture than just classified loans are up.
Definitely. It seems more like prudence than panic.
And did this caution maybe filter into their outlook for loan growth?
It seems so. They did adjust their full year 2025 loan growth forecast. It was mid to high single digits.
And now?
Now they're guiding towards mid single digits. They mention general economic uncertainties and also something they call tariff noise.
Tariff noise?
Yeah.
Interesting phrasing.
Yeah.
But loan production itself is still okay.
Yeah, they actually said loan production remains strong heading into Q2. So the pipeline seems decent. They're just maybe being a bit more selective or cautious about the overall environment.
Gotcha. Where was that Q1 loan growth strongest?
The big areas were warehouse lending, lender finance, and fund finance.
Okay.
That growth kind of offset a decline we saw in construction loans, but that was mainly due to projects finishing up and loans getting paid off, so natural runoff.
And you mentioned the shift towards warehouse fund finance. That's strategic.
It appears so. Management highlighted these categories are generally seen as lower risk, shorter duration.
Which impacts reserves.
Exactly. Lower required reserves under CECL.
Yeah.
So it's a bit of a portfolio tilt towards maybe less capital intensive, safer assets given the uncertain outlook. They also mentioned purchase residential mortgages as part of that mix.
Makes sense. Let's circle back to the buyback. $150 million done. And then they authorized more.
That's right. They announced another $150 million authorization, so $300 million total program now, covering both common and preferred stock. And they said they'd deploy it opportunistically. It signals pretty clearly, I think, that they believe their stock is undervalued.
Returning capital, showing confidence. What about the other side of the coin, expenses?
Yeah, expenses. Q1 non-interest expense was $183.7 million. That included some higher comp costs and a $1 million donation.
Okay. Any guidance for Q2?
They expect it to tick up slightly in Q2 to the low end of the $190 to $195 million range.
Higher expenses, but
they expect positive operating leverage in Q2, meaning revenue growth should outpace that expense increase.
because of the loan growth feeding into NII.
Precisely. The net interest income generated from that strong loan production we talked about is expected to more than offset the temporary bump in expenses. They see it returning to more normalized levels after Q2.
Okay, so that hinges on net interest income holding up. Right. How did NII actually do in Q1?
It was $232 million, actually slightly down from the prior quarter.
Oh, why was that?
Few reasons. Fewer days in the quarter, that always has an impact. Also, fewer loan prepayments, which can sometimes juice NII a bit, and just the general impact of lower market interest rates.
But wasn't it offset somewhat?
Yes, partially offset by lower deposit costs. They managed to bring those down.
How'd they manage that? Rates are still relatively high.
They passed through some rate reductions. The average cost of deposits fell 14 basis points in the quarter, down to 2.12%.
Okay.
And interestingly, the spot cost right at the end of March was even lower, 2.09%. So they're managing that side actively.
Good control there. But didn't average loan yields dip a bit too?
They did, yeah. Average loan yields decreased 11 basis points to 5.9%.
And the reason?
Mainly the lag effect of prior rate cuts hitting their floating rate loans, plus that slowdown in prepayment fee income I mentioned.
But the new loans are coming on much higher.
Exactly. That 7.2% yield on new production is the key offset there. And their spot loan yield at quarter end was actually a bit higher than the average at 5.94%. Suggests the portfolio yield should benefit as more of these new loans season.
Right. The overall yield should hopefully trend up as that new higher yielding stuff makes up more of the book.
That seems to be the expectation.
What about the bigger picture, the California market, competition?
Management sounded pretty optimistic, actually. They see opportunities opening up as some other banks pull back or exit the California market.
So consolidation helps them.
Potentially, yeah. They want to be a key business bank in the region. They even mentioned the recent Columbia Pacific Premier merger. They see it as validation that California is attractive, but also, frankly, one less competitor.
Interesting take. Are they seeing stress among their actual borrowers yet? Any change in behavior?
They said not really significant changes in Q1 or early Q2. However, they did note more conversations happening. Clients are talking more about a potential economic slowdown. So while behavior hasn't shifted dramatically, the dialogue has. And that's reinforcing the bank's own cautious stance on new loan production.
So watchful waiting seems to be the mood.
Pretty much. On tariffs, they feel their direct exposure is minimal, mostly indirect ripples, if anything.
Okay. Any other specific targets or projects they mentioned?
Yeah, a couple of things. They want to get non-interest-bearing deposits up to 30% of total deposits by year end. They're at 28% now, so making progress.
Okay, nearly there.
And they talked about this Project Reset. It involves a specific large portfolio of brokered multifamily loans. These were originated at lower rates.
Right.
So the project is about actively working with these borrowers to keep them, but at current higher rates, think around 6%, rather than letting them refi elsewhere potentially cheaper.
Trying to reset the rate and retain the relationship, do they think the borrowers can handle the higher payments?
They expressed confidence, said the portfolio is solid overall. Borrowers generally have the capacity to absorb the higher rates.
Okay, that's a key initiative then. What about their loan loss allowance, the ACL?
Their ACL ratio was 1.1% of total loans. They calculate an economic coverage of 1.66% if you factor in credit marks and some other notes. They sounded pretty comfortable with their CECL model assumptions too, said they include a 60% recession scenario, which they view as conservative.
And going forward, do they want that ratio to go down?
Actually, no. They indicated they'd prefer the ACL ratio not to decline further. Ideally, stay flat or maybe even grow a bit, supported by what they hope will be positive risk rating migration over time.
Interesting. Hold the line on reserves. Okay, that's a really thorough look. Seems like they're navigating carefully, focusing on risk, but still finding growth.
That's a fair summary. Strategic adjustments, cautious optimism.
All right, let's shift gears then. Time for our This Is Not Financial Advice segment. Wild yet plausible trade ideas based on the call. What have you got?
Okay, so thinking about the active buyback, the focus on NII growth from those higher yielding loans and their sort of opportunistic view. Here's one idea.
Lay it on us.
Given they can buy back common and preferred, and common stock might look particularly attractive valuation-wise for buybacks, maybe consider a relative value play.
Okay.
A hypothetical long position in Bank of California common stock, paired with a short position in, say, a similarly sized regional bank peer that's maybe expressed concerns about deposit costs or outflows recently.
A pairs trade. Betting on Bank of California outperforming a weaker peer.
Exactly. Leveraging their buyback support and perceived earnings momentum against a competitor potentially facing different, maybe tougher headwinds. It's about the relative performance.
Intriguing. Playing the divergence.
Yeah.
Okay, definitely plausible if wild. And remember, everyone.
Not financial advice, purely hypothetical brainstorming here.
Absolutely. Do your own research, always. Okay, great stuff. As we wrap this deep dive on Bank of California, what's the one single insight you think folks should really hang on to?
For me, it's probably that proactive risk rating adjustment. Taking tougher action on loans before they become real problems, even if they're still performing.
Yeah. Why that specifically?
Well, it suggests a management team that's looking ahead, trying to anticipate issues rather than just react. In uncertain times, that kind of forward-looking prudence can be a really important signal about potential long-term stability.
Good point. Prudence pays off. Okay, thanks for breaking that all down.
My pleasure.
And thank you all for tuning in to TalkTickers. Hopefully that gives you a much clearer picture of Bank of California's quarter and outlook. Join us next time as we tackle another key earnings call. We're here to make sense of the market, one call at a time.